I'd like, on the behalf of the Brazilian Finances Society, welcome all participants to the second panel of our conference. The topic of this session is liquidity and firms after COVID-19. I would like to thank all the sponsors for helping all the activities performed by the society, including this meeting. Before I pass the word to all speakers, I'd like to explain briefly some rules of our conference. The session will last 90 minutes. After the speaker presentation, we will have 20 minutes Q&A session. Questions will be selected by the moderator from the ones submitted via Zoom Q&A option. Please try and keep your questions short and to the point. This will make easier to the panelists to answer. Last, I'd like to thank all invited speakers. I believe they don't require any introduction, and all participants are anxious to hear their thoughts. It's a truly great honor to have you, Heitor, Rajan, Sascha, and João Manoel with us. So without further ado, I pass the word to Heitor, who will also moderating this session. Thank you very much.
Thank you. Good morning to Raghu here in the US, in the Midwest, and good afternoon for people in Brazil. Good evening for Sascha, I guess, right? Sascha is in Europe. And thank you for inviting me to organize this panel. It's a pleasure. It's too bad that we can't be together. By the way, can everybody see my screen? Yeah. Too bad we can't be together this year. Usually at this time of the year, I'm in Brazil teaching my course at INSPER and meeting my friends in academia in Brazil. But this is a different year, right? Which is exactly what we're here to talk about. So we're going to talk about the corporate finance side of COVID-19, and I think we have some excellent panelists. I'm looking forward to the presentation. Rui asked me to, and Rui and Alan asked me to do a small introduction to the topic and introduce our speakers. So that's what I'm going to do. So it's just less than 10 minutes, and then I'll pass the baton to Sascha and Raghu and João. So COVID-19, right, is a different type of crisis when we compare it with the previous financial crisis that we had to live through, right? Which was the 2007 and 2009 financial crisis, which hit mostly households and banks, and the corporate sector was hit only indirectly. And COVID-19 is different, right? Because COVID-19 is a direct hit on non-financial corporate cash flows and therefore balance sheets as well. So it's a sort of a Main Street crisis, right? As some people are saying here in the US. So just to give you some data, I think this chart is interesting to show the magnitude of the profit shock, and also something else I'll talk about in a second, but these are rolling earnings forecasts for the S&P 500 taken at different timestamps, from 2015 until recently. And what you can see here is just focusing on the green line and the red line. The green line are the profit forecasts as of February, right? So right before the lockdown started, analysts still expected earnings to continue growing at a normal rate as late as February. And then, of course, once COVID-19 hit the US economy, I mean, this is for the US, of course, S&P 500. So then we shift to the red line, which, basically shows the magnitude of the profit shock for US companies. The other thing that this chart is showing is that right now, the expectation is that earnings will start growing again in 2021. You can see that the red line, right, is picking back up, and this graph ends at the end of 2021. So one question I think we're going to talk about today is, is this recovery really going to happen, right? What does this depend on? It's just a forecast, right? And, it could happen or not. So it's a large negative shock to corporate profits. As of today, a recovery in profit growth is expected for 2021. And the question that I think our panelists are going to address today is, what should companies and policymakers do in this scenario, right? So what have companies done? What should they keep doing? And is this recovery that is being forecast in the US really going to happen? And in addition to that, we're going to focus on emerging markets as well, right? So Raghu is going to talk about emerging markets. João is going to talk about Brazil. How may emerging markets differ from the US, right? And I think this is going to be a great discussion. Let me just introduce, what I think is one fact that we know about how companies reacted to COVID-19. So, this is just a sketch, right, of the company's liquidity management response to COVID-19. So they were hit with a low cash flow, right, with a cash flow shocks. Today, here is 2020, right? And I think what the data in the US shows, Sascha is going to talk more about this, is that companies responded to the cash flow shock by increasing long-term debt. So companies borrowed long-term, right? And their goal was to increase cash holdings. So both long-term debt and cash holdings increased in 2020, right? So it's clearly a liquidity management strategy. The expectation, of course, is that when tomorrow comes, like 2021 or later, right? Of course, companies are going to have to repay the debt, right? That was issued this year. But by then, COVID-19 will be over, cash flows will be back up, and everything is going to work fine, right? So clearly, what companies did relies on a recovery of cash flows, right? Which is a reasonable assumption, but definitely not guaranteed. So I think this is something we're going to talk about later. And in the US, at least, Sascha is going to address this as well, but I think the way that I understand the US government response is the US government basically helped US companies issue long-term debt in 2020 by increasing liquidity in that market. So the different, especially the corporate credit facility and Main Street, are programs that support liquidity in debt markets to allow companies to issue long-term debt, which is basically what companies wanted to do. Sascha is going to tell us also about credit lines, which is another source of liquidity that companies used to manage their liquidity during 2020. Okay, so without further ado, let me talk about our speakers, what they're going to talk about. Sascha Steffen is a professor of finance at the Frankfurt School of Management, doing a lot of research on banking, financial intermediation, top publications in all the top finance journals. Sascha has a special interest in understanding how financial regulation affects the corporate sector, and so I think he's an excellent person to tell us about US and Europe, in particular because Sascha is doing very timely research joint with Viral Acharya on the impact of COVID-19 on the corporate sector. And in particular, he's going to tell us about what he calls the dash for cash, which is related to what I was showing you in a second, and also discuss potential implications for credit risk and financial regulation. So I'm looking forward to Sascha's talk. Then we have Raghu Rajan. We are, of course, thrilled to have Raghu here. Raghu needs no introduction like any of the other speakers, but it's really a pleasure to have him join. Raghu is the Catherine Dusak Miller Distinguished Service Professor of Finance at Chicago Booth. He has an extensive policy resume as well. He was the governor of the Reserve Bank of India, and before that, he was the chief economist at the IMF. He's a top researcher as well. Continues doing research. Many awards for all his research. He's also a prolific book writer, right? And we're always looking forward to hear what Raghu has to tell us about. What he's going to focus on today is the impact of COVID-19 on emerging markets specifically, and what the world can do to support repair and recovery. So we're thrilled to have Raghu join our panel. And then finally, we have, I think, the perfect person to tell us about Brazil, which is who is João Manoel Pinho de Mello. João is another combination of a policymaker and an academic. and a top academic. He is the Deputy Governor for Licensing and Resolution at the Central Bank of Brazil. He has held other positions as well, the Secretary for Economic Policy and Promotion of Productivity and Competition Advocacy at the Brazilian Ministry of Finance. Very long titles, right? Like the Brazilian names, you know. So, and he's also professor at INSPER, the same school where I usually spend, you know, part of my summer, not this year, right? But we are colleagues too. And besides his extensive experience with policy work, João is an accomplished academic working in microeconomics of banking, crime, IO, top publications in finance and economics. So he's the whole deal. And he's going to discuss how the Brazilian government responded to the COVID-19 crisis, and in particular tell us about the liquidity programs that the Brazilian government has created to support financial markets and specifically small and medium enterprises. So without further ado, let's start. We're going to start with Sascha. Then we're going to go to Raghu and end with João. That's how we organized it. Alan told you, everybody, the rules, right? Keep questions in the Q&A, and I'm going to be keeping time here as well to make sure we move along. So thank you very much. I'm thrilled to be here, and let's get started. Sascha?
Okay, let me share my screen. So can you see my screen? Perfect. Thank you, Heitor. Thank you also, Ellen and Rui, for the kind invitation. It's a pleasure to be here and talk about this corporate dash for cash. And part of what I'm going to talk about is joint work in different papers, both on the bank and the corporate side, with Viral Charia and Rob Engel. So Heitor has set the stage very well. So this lockdown has plunged a large number of firms into an impending liquidity crisis, and the major focus of my presentation is therefore going to be, so how did firms deal with this liquidity shock, and what is the role of financial markets in providing this immediate type of liquidity? So I think if you cannot talk about the implication of the corporate sector and sort of ignore the banking sector at the same time, given that basically the banking sector provides credit for all firms across the credit spectrum, in particular the risky firms in both in the US but also in other countries. So this is why I'm going to first talk a bit in depth about this dash for cash that happened early March in 2020 until April, and what the effects of the Federal Reserve policy was, and kind of splitting this period into two phases. And by doing that, I'm going to try to highlight the most salient implications for the corporate bank balance, of the corporate balance sheets during these times. But Sascha, then
I'm so sorry to interrupt you, but I guess you are not showing the slides in the slideshow model.
Oh, can you see it?
I see all the slides at the same time, not the slideshow.
Yeah,
mode.
We can see your screen, but not. Did you turn on the slideshow?
I did.
Oh, okay. Let's try again. Yeah. Oh, yeah. Perfect.
Perfect. Thank you.
So and then I want to focus a little bit on the banking sector, and particularly because of at the same time when firms benefit from having this liquidity insurance through the credit lines, it's the banks that basically face kind of the risk from this aggregate demand for cash that we've seen in early March. Yeah? And I want to ask a specific, or two specific questions at that point. And the one is, in addition to the probably elevated credit risk on bank equity, is there also a loss in franchise value of banks' equity because they provide this aggregate liquidity insurance to the corporate sector and basically ex ante commit a large proportion of their equity? And then I want to ask a second question. So what are the implications of COVID on the supply of bank credit? Yeah? And most of the evidence I'm going to show you is based on US data, simply because of data availability. The European data is just becoming available. But so what I've looked at, it's broadly consistent with all the results that I'm showing you. So, but what I'm going to do at the end, I'm going to show you a little bit of evidence from the recent European Central Bank bank lending survey that has been published 2 days ago, and look at basically a question. So how did the credit supply of European banks tighten? What is the role of government-sponsored lending? And what might be the implication of that for the economic development and financial stability going forward? So these are the questions I would like to address then. So at the beginning of this stress period in early March 2012, we've seen that banks basically, that firms started maxing out their credit line, right? There was also Bloomberg and other media reported on that early on, and the key issue was that the other sources of funding became unavailable, right? And I would like to show you 2 pictures how you can see that. So this is the development of the credit spreads in the commercial paper market, so which is available for the highest quality firms. And you can see that in early March 2020, you see a spike in the borrowing costs, both for the highest rated, but also for the lower rated investment grade firms in the commercial paper market. So apparently there are substantial problems in the commercial paper market, even for the less risky firms. And then as a second piece of evidence, I'd like to show you the yield to maturity of corporate bonds across the rating spectrum. In the upper panel, you see the investment grade categories. In the lower panel, you see the non-investment grade. But basically, throughout all credit categories on the right-hand side, you see the spike in borrowing costs in early March. So basically, there's a broad freeze in debt capital markets for most firms, and that's the reason why these firms starting to rely on the liquidity insurance that they receive from banks' committed credit lines and start drawing down basically simultaneously, so basically posing an aggregate demand for credit line drawdowns to these banks. So an interesting question to ask is sort of how does that immediate demand for cash compare to past recessions, right? And so what we did is we tried to compare if we take the end of 2008 scenario as given and look at what would that kind of drawdown rate imply in expectations for possible drawdowns during a stress period like that, then this is what comes out. So you can see this is the third column, the expected drawdown rate based on what we observed at the end of 2008, basically for a full year over a very long period of time across the different rating categories. And then sort of the expected drawdown in total for all firms would be roughly 314 billion. If we now look at what actually happened individually in March, in April, and then together, we observe that basically during a very short period of time, basically everything condensed in March this year, we see that the drawdowns basically exceeded what has happened in 2008 as a whole, right? Particularly if you look at, for example, the BBB rated companies or the non-investment grade rated companies with drawdown rates in March alone exceeding 30%. This is substantially more that we've observed during the 2008-2009 financial crisis, right? And then in April, there's still drawdowns. You can see that this is relatively moderate. And I think the bottom line of that is there has been a run on credit line that has been very condensed, actually in a very few weeks in March alone. And this was particularly elevated for the riskier firms in the credit spectrum, particularly the non-investment grade. And I'm also counting the BBB into that category based on that immense increase in bond issuances that we observed over the last 5 years or so, in which particularly credit was given to relatively low rated firms. And this will be a focus on my talk later on, might be at the brink of becoming these falling angels. So there might be something specifically important about these types of firms. So how does this cash for dash for cash actually played out? And I would like to think more, look at this first, and basically looking at quarterly balance sheet data. And I think what's becoming most obvious is what's happening towards the right hand between the last quarter of last year and the first quarter of 2020. On the left hand side, you see the cash to asset ratio of basically all publicly listed firms in the US. And on the right hand side, you see the cash over cash plus undrawn credit line. And I do this for all firms across different rating categories. I think what's obvious, and this is something that's not surprising, more financially constrained, therefore unrated firms usually hold more cash. But I think what's particularly interesting is that towards the end of that graph in the first quarter of 2020, we see an increase in cash holdings or in cash to asset ratios for basically all firms. But this is maybe not that visible here, but if you run that as a regression, and with all the controls, the increase in cash asset ratio was particularly large for non-investment grade and BBB rated firms. The right-hand side has a little bit, the right panel has a little bit of different flavor because it shows you a bit more sort of the preference for cash of firms controlling for total liquidity, right? But you see basically the similar picture to in the first quarter of 2001. There is a preference for cash across all firms in this credit spectrum. And if you look at this on an average, the cash to total liquidity ratio increased on average by 20% in this first quarter alone. Right? So there is this preference for cash, so this cash is king attitude in the first quarter. And I think the one important thing to consider is that balance sheet become more highly levered by doing so. Yeah? So in the first quarter alone, the average debt to asset ratio, total debt to asset ratio increased by 7%. And particularly so for the highly levered firm, right? Less for the AAAs, but then for the BBBs, non-investment grade in particular. So when entering the second half of 2020, firms are much more highly leveraged than they used to be, and they have been leveraged relatively highly when they actually enter the stress period. So I think given that a lot of that action in the stress period happened in early March, it makes a lot of sense to look at a little bit more granular data that you can see sort of the dynamics that happened in March alone. So I'm going to look at actually daily credit line drawdown data that we got provided for the US. On the left-hand side, you see the cumulative drawdowns in $1 billion. On the right-hand side, we split that into the rating categories, and the vertical line highlights the 23rd of March, which is the announcement of the corporate bond buying program of the Fed. And so what you can see is basically this increase in cash in drawdowns, particularly in the first 3 weeks of March, in which firms rush to draw down the credit lines. And if you look at also the intensity, if you basically look at how conditional on firms drawing down within the first 3 weeks, the aggregate drawdowns approach relatively quickly 60% of all outstanding credit lines. So there was a rush to basically draw down all credit lines for these firms. And what you observe here on the right-hand side, the Federal Reserve a bond buying program announcement basically cut that period into 2 phases. The first one, in which basically all firms increased the credit line drawdowns, but then in the second phase, starting at the end of March and then going into April and alone, the highly rated firms reduced the borrowing from the credit lines, but initially, particularly the risky firms, the BBBs, but also the non-investment grade, they had to remain to rely on credit lines. Right? So let me show you a bit different how that looks. So this is, I think, just a little different illustration, but shows you the same thing. There's this immense, this high drawdown intensity in March, and then in April, basically for the highest rated firms, the drawdowns are substantially low, and only the riskier firms still have to rely on these credit line drawdowns. So let's look at this in 2 more ways. Let's look at this first of all in terms of drawdown intensity, and then in terms of what is a borrower risk has to do with that. Yeah? And here what I'm plotting here is for each rating category, and R is unrated or not rated, is sort of on a daily basis the drawdown as a percentage of the credit line limit of the firm. And what we can see is basically this is the scatter plot, and then we see this fitted line, and there's a negative slope of this fitted line across a different rating category, meaning that intensity of drawdowns decreased as the stress period progressed, right? So even in the beginning of March, even the highest rated firms had a substantial intensity of drawing down, some firms up to 100%, but then the AAA basically stopped more or less drawing down at the end of March after the government program set, or the Federal Reserve program set in, and they likely regained access to the bond markets. So what else, if you look at the steepness of the slope, and I think this is most informative, the steepness of the slope actually decreases from the high to the lowest rated category, meaning that for the riskier firms, non-investment grade in particular, the drawdown intensity didn't decrease as much as for the highly rated firms, meaning that they had to rely on the credit lines for their cash needs that they might have. So this is one side. The second side I would like to is basically on bringing corporate risk into that picture. So that is the same graph, just basically all credit categories into one picture. And you see the same intensity as a scatter plot, but now you see this dashed line, which is the Z-score, which is on the right scale of that graph. An increasing Z-score meaning lower credit risk. So at the beginning of March and until the 23rd of March, we see an increase in credit quality of firms drawing down the credit lines, meaning there is very much consistent with the precautionary drawdowns of even the highly rated firms entering the market. And then after the Federal Reserve stepped in and opened up alternative markets, we see a decrease an increase in the riskiness of borrowers still drawing down the credit lines, right? So apparently the alternative markets haven't opened up for these firms, but for the higher rated firms, so they drop out of the market for credit lines and likely entering the corporate bond market. Right? So let's look at that. Let's look at what the corporate bond market looked like over time. And I think this is exactly consistent with what I just said. So you see here the cumulative bond issuances of the different rating categories over time. And you see that until mid-March, beginning from mid-February until mid-March, the bond issuances have been muted across rating categories. Yeah, only particularly with the AAAs, with the commercial paper program, and then again the vertical line, the corporate bond buying program, they see this substantial increase in borrowing from the AAAs first, and then eventually the BBBs also increased bond issuances, but at a smaller pace compared to the highest rated category. But importantly, the non-investment grade, it took a long time until they could actually issue the first bond, not until the 9th of April when the Federal Reserve actually included also more non-investment grade into the buying program. So this is one, but I think the second important result or a message to take away from this is sort of the difference in the availability of bonds between the BBBs and the non-investment grade, right? And that highlights specifically that risk of the riskier BBBs who have increased bond issuances before the pandemic happened and are actually riskier than the BBB category might suggest. So these firms might actually be on the verge of being downgraded, and that difference in credit availability tells them, okay, what is actually a cost of being downgraded, the lack of being able to issue debt in public markets, and if probably only at higher cost. So that is the one risk that they face, and the second risk is exactly the costs. If you look at this is actually the difference in yields of firms issuing public debt during that time, and particularly important, the upper line, which is the dashed line, which is the difference between the yield to maturity of newly issued bonds of BBB versus non-investment grade rated firms, meaning that this line is increasing, meaning that if BBB firms were downgraded to non-investment grade, they would also face a steep increase in the borrowing costs. So both the lack of availability and the increase in borrowing costs suggests a possible problem, right? So this is why we looked at this specifically, and you can see here the stock price performance on the left-hand side of the rating of the different rating categories on the right-hand side within the BBB rated categories of those that remained BBB versus those that actually have already become fallen angels. And you can see that the BBBs behave more similar in terms of stock market performance to the non-investment grade in general, but particularly there is a substantial decrease in equity value of the fallen angels.
Sascha, so sorry to interrupt. Just to let you know, like about 5 minutes.
That's fine.
Okay,
that's
great.
fine.
Thank you.
I just skipped something. And if you look at sort of how into the credit line drawdowns, you see that those riskier BBB rated firms that might have are more at the verge of being downgraded also draw down more from their credit line, potentially to try to avoid being downgraded in the first place. So I think this is something which is particularly important. So let me, in the last couple of minutes, and I think this might be more interesting also to look at what are the implications on the banking perspective, right? Because on the one, this is two sides of the same coin. On the one hand, firms benefit from the liquidity insurance, but banks actually are at risk when they face an aggregate downturn, aggregate drawdown. So what we did is we looked at not the liquidity of firms, but the liquidity risk of banks over time, and we defined that bank balance sheet liquidity risk as basically the unused credit commitments that they have off balance sheet plus the wholesale funding minus the liquidity scaled by total assets. And I plot you this on the left-hand side. You can see that liquidity risk has been much, much larger during the global financial crisis. But at that point, it was mainly driven by actually wholesale funding of these firms, of these banks. And that actually came down a lot. But if you look at the increase in liquidity risk on the right-hand side since 2016, that is mostly driven by an increase in credit commitment to the corporate sector. And on the right-hand side, I'm going to plot you, if that is an aggregate shock to the banks, what does this imply for banks actually providing that kind of liquidity insurance? And you can see that it is priced in bank stock returns. So there is the banks that provide that much of balance sheet liquidity for firms are the ones who have performed worse. So the stock markets declined more. The decline was persistent, and if you were to extend that graph beyond the April period, you would see that the bank stock price have remained muted in terms of stock price performance compared to the corporate sector, right? And that is one of the reasons why we're saying that, look, it's not only about the risk of the balance sheets of banks per se. It's basically the commitment that they made, the capital that they need on the one hand to fund these commitments, but then also a loss in franchise value because they have pledged so much of their capital to the corporate sector in the first place that which prevents them from doing other good projects in the future, which sort of is reflected in this mutual stock price. So I think this is one thing on the bank side which is important to look at. But the second one, and here I would like to switch a little bit more to the European perspective. So this has been just published 2 days ago. So the results of the bank lending survey of the European Central Bank, and this is basically looking at the tightening of lending standards. If the graphs actually are positive, this means a tightening of standards. If it's negative, it means it's actually a less tightening compared to the previous period. So what we can see is that there's on average, this is this blue line here on the left-hand graph, there's a slight tightening of the credit standards, but something which is actually loosening is this purple part of the graph, and that reflects the government guarantee program. And then it's interesting to actually look at that at the different countries, right? Germany, actually, that was actually quite a surprise. German firms almost, they didn't really participate in the government lending programs at all. So that was completely overestimated. But in Spain, France, and Italy, you can see that in all countries, there's actually a relaxation of lending standards compared to the previous quarter, which is driven by mainly by the government guarantee programs in Spain and France, in addition also to an increase in risk tolerance on the part of the Italian banks. And I think this has a couple of implications. On the one hand is what happens if the credit programs, the guarantee programs stop, then we would see a tightening of lending standards again. Yeah, but then also what actually tells us this about the quality of loans that have been made, because particularly in those countries where we see a relaxation of lending standards, and you can see that here actually a decrease in rejection rates substantially, are those countries where we likely have the weaker banks to begin with. Yeah, so there's a high likelihood that there's not only an increase in debt on the balance sheet of the firms in these countries, but also of those firms that shouldn't have get the credit to begin with, where banks try to roll over bank credit, and which is fully or partially guaranteed by the government of the specific countries. So let me just summarize what I discussed, and I think this is then food for thought for the discussion maybe. But I think in early 2020, March 2020, we saw this aggregate demand for cash, or this dash for cash. We see that there's a leverage of particularly firms increases, which might potentially worsen the debt overhang problem going forward, and high quality firms actually now started raising bonds and repaid their credit lines. We see that role of banks as liquidity provider through this credit line puts pressure on bank equity and might affect bank lending going forward, because they have committed the equity through these credit lines. And then the role of the government support likely increase balance sheet leverage, because it increases actually lending in the different countries, potentially also worsening a debt overhang of these firms. It might prevent efficient liquidation of firms if there's just a rollover of bad credit on the side of weak banks, which potentially leads to zombie lending. And then, given also that what we know also from the academic literature over the past two crises, also in Europe, what are the implications for economic growth and also for financial stability if we continue to funding these bad firms going forward? Thank you very much.
Thank you, Sascha. Excellent. Thanks a lot. Our next panelist is Raghu Rajan. Raghu,
sure.
share your screen.
Let me share the screen if I can find it. Okay. Do you see it now? You see the screen? Great. Okay.
Yes.
So let me go through a somewhat higher. I think Sascha was at the 5,000 feet height. I'm going to go up to maybe 30,000 feet and talk a little bit about what's happening in emerging markets and developing countries as a reaction to the coronavirus. I'll come down to the liquidity problems a little later, but I want to set it in the broader context of what's been happening on programs. So start first with the fact that actually this description, emerging markets and developing countries, is actually a very tired one, because they have very different situations. As many of you know, if you look at the emerging markets from East Asia, they seem to have done extremely well in containing the virus. But if you look at Latin America, you look at South Asia, you look at Africa, it's an ongoing issue. Now, I want to structure the reactions to the virus into 4 different phases, not necessarily that these are completely segmented, but it's useful to think about this way, because this is a special kind of crisis. As Heitor said, it's not your traditional crisis. Clearly, in the process of combating it, the first step is to contain the pandemic, and we're still working on it in the United States, in Brazil, in India. But while you're containing it, it's also important to provide relief to the weaker sections of society so that they can survive without incomes as they're locked down, but also to small and medium enterprises that need cash for survival. The second part, once you have sort of re-emerged after lockdowns, is to repair the firms that are damaged. Sometimes households also need repairing. Repairing means potentially new credit, but it also means restructuring the old credit if you have excessive debt, so that you don't have a debt overhang problem as you try and grow. It also could mean liquidation, reallocation of assets into some other entities. It could mean consolidation as stronger entities buy up weaker entities. But there's a whole process of both repair and reallocation that will have to take place, especially if your relief efforts have been very modest. You've not been able to protect households and firms that strongly, then you have more of a work to do on repair and reallocation. Now, the recovery process is the next one. And this is where, you know, people sometimes talk about stimulus, the traditional stimulus. We need big projects so as to get growth going, given that demand is likely to be weak as we recover. And we also need external sector demand, especially if the emerging markets are not able to pump up demand on their own. But this recovery process then looks a lot more like the traditional recovery, where you talk about various forms of Keynesian stimulus as well as external demand. And the final issue is, you know, if you can't do much on some of these dimensions, perhaps the only way for growth is through significant reform. But of course, we know that the initial effects of many reforms is negative for growth. And therefore, it's hard to rely on that for substantial growth in the short run. But in the medium run, this may be the only way to increase growth potential from the lows that it reaches during the pandemic. So I'll talk a little bit about all that. Let me start first with the containment efforts, right? Many emerging markets and developing countries tried exactly what the industrial countries did, a total lockdown. But of course, we have different conditions in these countries, and the outcomes differed somewhat in many of them. First, the populations are younger and often less obese, both of which are risk factors for whether the virus gets problematic. In general, populations are somewhat less healthier, but it seems that the younger and less obese aspects have made a big difference in death rates. Second, unlike industrial countries, fewer jobs can be done at home in the emerging markets. This chart by a group of colleagues at Chicago basically shows that as you increase your per capita GDP, you become more service oriented, you become more less material oriented. And so you can do your jobs at a greater distance. The fraction of jobs done at a distance, for example, in Sweden, approached close to 45% of GDP. On the other hand, in Mozambique, it's more like 5%. So as your GDP increases, you can do more work at a distance, which means that lockdowns have less effect in those countries because more people can be working, as we are, at a distance. But that's not true for many emerging markets and developing countries. People lose their livelihoods, and households and smaller businesses in those countries also have lower buffers. There's no automatic buffers that kick in, and so there is a lesser ability to bear sustained lockdowns. And of course, as you know, even if you lock down, social distancing is much more difficult. I mean, in the slums in Dharavi, in Mumbai, or the favelas, it's much more difficult to distance people, and there's much greater dependence on public transport. So even the lockdowns themselves have less effect. There are obviously other factors that come to play. Migrants with no safety nets. This has been a big factor. People, Venezuelans who went to Colombia, traveling back because there's no support in Colombia during the virus. In India, massive internal migration from the cities where the virus is strong to the rural areas because people didn't have jobs or support in the cities. And of course, worse medical facilities. The bottom line here is that lockdowns have very differential effects in these countries. They've been much less successful in containing the virus. And some have relaxed the lockdowns before containing the virus. So the old playbook that we bring the number of cases down to a low level, then we test, and then we track in case there are outbreaks, and we have localized lockdowns, but by and large, we can open up the economy. That doesn't seem to be possible in these countries. We are opening up in a number of emerging markets, even while the virus is still pretty strong. Fortunately, however, deaths are still low, and this is something we don't quite understand. So this is the chart that many of you have seen, the progress of the virus. The top country, unfortunately, is the United States, but second is Brazil and third is India Obviously it is work in progress to contain the virus. But what is interesting is the death rate. The number of deaths per million is significantly lower in the lower and middle income countries than in the rich countries. And we don't quite understand this. It may be the younger populations. It may be that somehow in rural areas there's more effective distancing, not quite known. But this is the saving grace. We don't have as big a calamity in terms of deaths. Of course, Brazil has had a large number. India has a large number, but it's still not anywhere near what it could be if it approached the rate that, say, Belgium has. At the same time, have these countries sort of dodged the economic bullet? And the answer is no, regardless of the lower death rates, because the economic consequences of the virus have hit them really hard. Many of these countries are especially exposed to the economic shocks the virus creates. Trade is down in many countries, especially if they were commodity producers, if they produce manufactured goods, which is where the emerging markets specialize. Trade is significantly down. Tourism, of course, is down. Remittances are down. And initially, many of our countries face capital outflows. Brazil is an outlier here. If you look at the capital outflows from Brazil in March, they were pretty significant. Of course, since the Fed response on March 23rd, you've seen a reversal and things have come back. But as I understand it, the exchange rate effects have been pretty pronounced in Brazil still, and they could happen once again if capital flows out again. So there's been much damage because many of these countries have had little scope for relief. And it's interesting. Why have countries in the West, in the industrial countries, they spent close to 10-12% of GDP in additional fiscal support? In the emerging markets, they haven't done so much. Central banks have expanded their balance sheets. Some have started directly financing the government, calling it some variety of QE. This is effectively fiscal financing of the government. But governments haven't used the opportunity to expand their fiscal deficit significantly, except, I mean, Brazil has done some, but many governments have been scared about doing more for fear of downgrades or exclusion from borrowing. India, for example, the effective fiscal impulse is pretty close to zero if you put everything together. And the consequence, therefore, has been that the damage done has been greater. For example, in India, we have a lot of migrants from different states coming into the urban areas. There's been very little support along the lines of Bolsa Familia for them. And many of them just left the cities, going back to the villages, taking the virus with them. So the net effect is enormous amounts of damage to the households, especially the poorer ones, but also to small and medium enterprises. Now, this is different from the traditional recession because these are healthy firms that, because they've not produced revenues for so long, 20 to 30% of the SME sector is never going to come back again. And that means growth and potential growth are going to be lower. Growth for sure in the short run, but potential growth because you've taken out a significant amount of economic capability, and that's not going to come back. So potential growth in these countries is also going to be lower, something which the countries that have spent much more have avoided. This is a chart put out by the IMF, which I think makes the point very, very clearly. If you look at the advanced economies in terms of additional fiscal support, that's the red line. Look at the bars on the right-hand side. The advanced economies have additional fiscal support of about 9% of GDP, additional credit support, loans, equity, guarantees of about 11% of GDP. So total about 20 percentage points of GDP. If you look, however, at the emerging markets, that's way furthermore to the left. The loans and guarantees is about 2 percentage points of GDP. The additional fiscal spending is about 3 percentage points of GDP. Not that much. And of course, if you look at the least developed countries, it's insignificant. And that is important because that means the amount of damage done in this crisis will be significantly more in these countries, and demand is less likely to spring back up after restrictions are lifted, yes, there'll be some pent-up demand, but longer-term demand is going to be much harder. And you can see this in some of the data in India. India, as I said, has released the lockdowns after a very severe lockdown initially. It was perhaps one of the most severe in the world, but after that, it stopped when it found that the economic damage was really severe. And what you see is, look at the gray line here, the mobility going back to workplaces has essentially plateaued at about 30%. For many industrial countries, it goes up to 20%. So there is a plateauing, but it is significantly less than where the industrial countries have plateaued at, suggesting that there might be some more longer-term damage in India from the lockdowns. So how can we improve the repair phase? How can we improve the damage that has been done and reverse it? Over 100 countries, poor countries, have approached the IMF. The level of sovereign defaults is going to be quite high, even though there has been a short-term moratorium on official payments. Essentially, many of these countries need much more fiscal space to spend, and many of them are continuing to service their private lenders despite having the moratorium from the public sector. So this is really very interesting. They do need moratoria from both the public and the private, and that will be something that I'm sure we will see negotiated in the months to come. For the EMs, corporate distress is a really big concern. The last crisis, as Heitor said, was a illiquidity problem for banks, and that translated into problems for households and so on. This crisis is really a solvency problem for corporations. We talked about liquidity earlier, and that certainly is there. But there are going to be many, many corporations which are insolvent. We've seen actually some evidence from NYU suggesting that there is going to be a mounting level of insolvencies going forward, probably unprecedented. But solvency usually means it's poorly managed, right? That this is an economically unviable firm. This time, because revenues have been interrupted for a long time, and because firms went into the crisis with high levels of debt, especially in emerging markets with significant levels of dollar debt, firms are insolvent simply because of the nature of the crisis. And therefore, they're viable, but they're insolvent, different from the typical recession, which is why it's extremely important to restructure their existing debts and to provide new funding so that they have the working capital to grow back as we get back. And I'm very curious to learn what Brazil has done here. But what is important here is not just the additional debt, it's also where the debt is too high to prevent an overhang problem. You have to restructure the debt down, which means the effectiveness of the restructuring process is extremely important. It should not be biased towards liquidation because you don't want to liquidate these firms. These are good firms. You want to rehabilitate them, which means you want to restructure, renegotiate, and sometimes, obviously, this will mean greater losses for the financial system. You need to recapitalize the financial system. What if you don't do anything? Well, you will have less lending because these are over-indebted firms. You have less investment, and you have the proverbial zombies that Sascha talked about. Too many firms that are over-levered and are underpricing because they're trying to, in a sense, gamble their way out of trouble. So that would add to the low growth that is already on the cards for these countries, and therefore it's very important this repair take place. Let me come to my last slide, which is, it is, to my mind, evident that potential growth will be hit severely. And, why is the market celebrating? This seems to me a lot like the phony war in 1939, where started the war in March, and then it seems like we've got some support from central banks, from governments, and we think things will be fine. But even in industrial countries, we're going to reach a fiscal cliff pretty soon. They can't continue support at the levels that they're supporting. And in emerging markets, the damage is already on the card. So let's say they find a virus, a vaccine tomorrow. It still will take till the end of the year to roll it out, at the very least, if not longer. And it'll be fully rolled out by March, April next year. That's the most optimistic we can be. And that by that time, the amount of damage that's done will be significant. Debt overhang, funding starved corporations, capital short financial sector, all this is going to be an overhang. We just saw the banks in the US finally admit that there will be significant loan losses in their loan loss provisions. And I think we'll see more of this going forward. Sascha talked about what happens if some of the credit guarantees move off, especially in Spain and Italy, which seem to be really dependent on credit guarantees this time. And of course, in emerging markets, that's going to be a big issue. The bottom line is, in the emerging markets, domestic demand-led recovery is going to be very difficult. We will have fiscal and financial sector constraints. They will need external demand to support growth, which means the global trade recovery is extremely important. One of the good news is China's back. China has come back very strongly. It needs markets. It needs trade. A lot of Chinese growth, I'm told, is because of inventorying rather than final demand. So it will need that growth. Cross-border investment will be helpful. But unfortunately, if you look at the global political situation, as we go towards the US presidential election, we're going to have more rather than less trade issues brought up. And that means that trade cannot be the rescue that we always thought. And that finally leaves the issue of reform. Maybe we can reform if you have the right set of circumstances, but reform is going to create the conditions for growth 2 or 3 years down the line and may cause shorter term pain. If you didn't reform in good times, are you likely to reform in bad times? Well, if it's the only hope, maybe it happens. But broadly speaking, I'm saying, this is a time to think about big solutions, because the small solutions are not going to work. And there are a huge amount of problems that are coming down the line. Let me stop there.
Thanks a lot, Raghu. Excellent. So our next panelist is João Manoel.
I got to get rid of the screen, the sharing.
Yeah, there is a button.
Yeah.
Thank you. João?
Heitor, thanks a lot for the invitation. It's a real pleasure. I'm not going to thank you for putting me to speak after Sascha and Raghu. It's a real challenge. Sascha was 5,000 meters and Raghu was 30. I think I'm going to be halfway, like around 20. Let me share this screen here. Just give me a second. Obviously, I think my presentation will be a little bit more with an institutional twist, but I still hope to convey some of the analytical challenges that we faced during this whole effort to respond to the financial and economic consequences of the pandemic, and hopefully also stimulate some of the researchers here to look at some of the questions that we're still struggling with. Just a quick outline. I'm gonna, just for context, give you a little bit of the background on Brazil and sort of an anatomy of the shock. I'll describe the policy responses and quickly show some of what we think are the preliminary results and outcomes. And then I'll speak specifically on SMEs and income support. I think it's important to speak of them jointly, because especially in many emerging markets, but Brazil in particular, given the characteristics of labor markets with a lot of informality, these two categories are sort of intertwined, and so policy responses should be looked as a whole. So I think this is what I call the anatomy of the shock. I think Raghu talked a little bit about the outflows. For instance, the outflows capital outflows from non-residents. It's just one dimension, but it's pretty illustrative here. When you compare the COVID-19 shock with the previous shocks like the China scare, taper tantrum, and a global financial crisis, we're talking something on a different scale. Also, if you look at Latin America, for instance, and emerging markets on PMI manufacturing, and obviously you see some of the conventional monetary policy responses to stimulate demand as a first response to try and work the bank lending channel. It's exactly what you would expect it, but the magnitude of the shock has to be noted. When you look at confidence, like numbers for Brazil, like confidence indicators, employment, and expectation for growth, the drop is again almost unprecedented. This is just basically the same thing, but just showing what is GDP seasonally adjusted for the first quarter. Our official number for 2020 is minus 6.5 percent of a drop in GDP, which is, I don't think Brazil is any special in this category. Now, just to give you a little bit of the first background on policy responses, one thing to have in mind is that except for some of the Fed programs, central banks, and here we have the Fed and the ECB, but I think if you look more broadly, you'll find the same pattern. Central banks had put a lot of arsenal in place. It's not all of that arsenal has been deployed yet, possibly for supply, but mostly for demand reasons as well. And I will show that Brazil is not a different. It's not a different case. We have deployed a lot of old and new instruments to provide liquidity. I'm going to go through this with a little more detail. Some of them were fully used, some of them were partially used. Our view here is that in facing a shock as aggressive and as strong as we did, that we had to deploy a lot of arsenal and make it available. And this is pretty much what we did, both in terms of providing liquidity and capital relief to the banking sector, which is our original mandate, but also in terms of measures to make sure that this liquidity percolates through the whole financial markets and then to get to firms in the end. I think Raghu talked a little bit, and I think it's important for context to have a sense of the fiscal response. This is a comparison across countries, and if you look at Brazil in terms of emerging markets, Brazil has put in place a relatively strong fiscal response, which is necessary. And our review is that we put the fiscal response exactly how we should have, meaning that we have maintained our long-term fiscal framework, which is basically the spending cap, and 2020 is treated here as a special year. So the long-term framework is in place so that we were able to have a relatively strong fiscal response, which we deem necessary, but contained to 2020. If you look at risk premium along the yield curve, you would see obviously some pressure on the longer tail, but not nearly as as much as you would have expected if markets were not confident that that the long-term fiscal framework is in place. The Brazilian Central Bank here, we have acted promptly to stabilize credit and financial markets. Evidently, a necessary condition to stabilize markets is the credibility of monetary and fiscal policies. We have to say that the Brazilian banking sector has gone into this crisis very well capitalized, and we have taken measures to relieve capital on the banking sector, so it's still well capitalized. Evidently, we will learn over time as events unfold the magnitude of losses, and we'll take a prompt action to additional action to guarantee that the banking sector is capitalized. It was really interesting as Sascha's presentation. We've seen something very similar in Brazil, and I will show the anatomy of what we saw in Brazil. We basically had what you could have called a different bank run, which was large corps withdrawing on credit line. Principle being, as Sascha said, cash is king. That has put a lot of pressure on the bond market as well, because yields went up, prices went down. The private credit fund has gone through a lot of stress, and that's why we thought that it was really important to provide extensive liquidity to stabilize the banking sector, and then to take measures so that it would percolate throughout all other segments of financial intermediation. It's important that in an emerging market context, the Brazilian Central Bank, up until 6 weeks ago, had a mandate to operate through the banking sector. We didn't have a mandate to purchase assets, for instance, directly from the fund industry or outside the banking sector. We have very rapidly passed, the Brazilian Congress has very rapidly passed a constitutional amendment, no less, to give the central bank a mandate for purchasing assets on capital markets, for instance. Just as a background, capital markets in Brazil were going, on the period leading to the COVID shock, capital markets in Brazil were going through a major overhaul. We had been going through a process of reducing earmark lending and increasing private allocation of capital with a very significant expansion of capital markets, especially for large corps. And that had a very interesting implication going into the crisis, because large corps moved to the bond markets, and that has positioned banks to increase their supply of revolving credit lines to large corps. That was the product that was in demand, given that bond markets were replacing longer term finance. And bank credit was expanding to SMEs and consumer finance. They were moving towards that segment. And obviously that has an implication for how the banking sector was exposed to SMEs and to these credit lines at the outset of the COVID crisis. Just to illustrate, this graph shows, for instance, the issuance of debentures and other instruments, which has been quite significant on the period leading to the COVID shock. Here's a table on the measures taken by the Brazilian Central Bank. As I said, we had put in place an ample scope of measures. For instance, the first and utmost important instrument that we did actually before the crisis was using our reserve requirements. This is from an analytical point of view, I think it's an important something that is worthwhile noting. Because of the way that the resolution framework that we have in Brazil, and the fact that we didn't have a very well-established liquidity support from the central bank, we always operated with high reserve requirements. And in fact, ironically, this is actually pretty good at the onset of a crisis like this, because you have reserve requirements and you can inject liquidity very quickly. Having said that, Brazil has put together a liquidity provision at record time. In a couple of months, we put together a liquidity provision to be able to rediscount debentures and private credit from the bank's balance sheets. This has been tremendously important into injecting liquidity in the banking sector. We have provided ample capital relief as well, by reducing, for instance, the additional principal capital factor that the Basel rules have, reducing capital requirements for operations with SMEs. We reduced capital requirements for the smaller bank segment. We have reduced capital requirements for interbank lending. It's not actually the like reserve markets, but actual interbank lending. And we have also revamped and reoptimized capital for the banking sector directed at lending for SMEs. We are very agnostic to ideology here. Our impression leading to the crisis was, from a structural point of view, the Brazilian financial intermediation had too much government direction and earmark lending. But in a situation as the crisis that we have, earmarking credit and directing credit to small firms seems like a good idea in terms of support, given the nature of the shock that we had that Raghu and Sascha have explained. We already have the mandate for asset purchases directly from capital markets that we are about to announce the details. So in terms of, as we said, of liquidity support, this has been a very strong policy reaction. Some of these, let's say, lines and actions have been more used by both the banking and the private sector. Some of them less used. The important thing is that the whole arsenal is there. In terms of liquidity support, just to compare Brazil with other emerging markets, we have, as a percentage of GDP, provided a much stronger liquidity support, and also a much stronger credit support. This materializes when you compare, for instance, 2020 and 2019 in terms of non-earmarked new credit transactions. We are still running above the 2019 levels, meaning that given the nature of the shock, we have been very successful into supporting lending and therefore supporting businesses and households. And interest rates also going down. So it's not that we have had a spike in costs, at least not from the banking sector. I have to say that this is also due to the fact that one of our main measures was to regulatory relief on provisions for debt renegotiation, that we let banks renegotiate without provisioning as previous regulations were demanded, but interest rates had to be kept at the same previous level. I'm going to go through this pretty quickly. This is only to put this into numbers. This is about 20% of the stock of credit in Brazil. This is pretty significant. So the takeaway from this slides is credit markets are well functioning, and are well functioning because liquidity and credit relief were provided. Now looking at capital markets, we have seen a tremendous pressure in the bond market, with obviously there are consequences for financial stability. We see spreads going up tremendously, volumes have spiked. The measures that we have taken that directly affect only the banking sector, but they percolate. So we have seen a stabilization of, obviously they haven't gone down to the pre-COVID levels, but a stabilization of yields in the bond market. And if you look at more recent data, it has been going down further. So apparently most segments of financial intermediation are well functioning. Let me just very briefly talk a little bit about the SME programs. We have in place as of now 2 SME programs. One for payroll financing. This is earmarked for payroll financing. It's about an $8 billion emergency line, and it has that is 85% funded by Treasury and 15% funded by private banks. Almost 2 million jobs, job support preservation commitments were made. Obviously, we can't say this is the causal effect of the program. We don't know if these firms would have maintained these jobs either way. But the fact is that the commitment is about 2 million jobs, which definitely helped cushion the labor market here. We also have another SME credit guarantee program, which is a budget fund from the Treasury of about a little less than $4 billion with a stop loss of 85%. And this is for working capital. This is for payroll financing, which is about 50% of the SME's expenses, and this is for working capital. It's important to say that the non-credit emergency programs are important to mention, because part of the reason why some of these lines or credit lines are not used is because we have the government has put forward a furlough program with a commitment to maintain job, and this, in our view, has been tremendously successful because there is a 12 million job commitment, the job maintenance commitment on this program. Obviously, we would have to work through to wait for events to fully unfold, and that's why we're putting together additional credit programs, because from a fiscal stance, it's costly to maintain this furlough program for a long time, and then we have to replace with credit programs, which, albeit supported by Treasury, is the fiscal impact in the longer term is obviously lower. And we also have put together, the government has put together a very widespread and strong cash transfer program, similarly to the $600 US check that has reached more than 60 million Brazilians and over 40% of the country's households, with a very significant monthly disbursements. Just to see the impact, for instance, if you look at payroll and real earnings, we have been able to substitute real earnings for the drop in payrolls for this period. So this has cushioned the impact on the economy and labor markets, and obviously provided a lot of relief. We will have to look very carefully into what it was great to hear Rajan's framework here, and start thinking about repair and possibly taking action to avoid liquidation, to flatten the curve on liquidation, especially because of the ability of bankruptcy courts in Brazil to adeptly liquidate firms. And any further action we will take. The government has announced today our new programs to redirect credit to small firms, yet again, without any fiscal impact, only using the bank's balance sheets and capital relief. So this has been the strategy so far, and thanks a lot.
João, thanks so much. This was excellent. You know, I learned a lot about how Brazil is tackling the crisis. Thank you. So I'm going to pass it to Rui and Alan. I think it's time now to get questions from the audience, right, Alan?
Yes, we just have 2 questions so far, but so I invite the audience to send your questions because this panel was really, really good with many views, ideas, and what makes us to think about. We have a question, I think, well, the first one is, I guess both are related to Rajan presentation. The first one is saying about could be underreporting be more severe in lower income countries and help to explain the gap between the number of deaths per million, right? And the second one is a little bit longer, the question, so let me try to, okay, I think it's better to read. Emerging market government debt. I'm reading, I think is easier. You have mentioned that around 100 countries have approached IMF to discuss issues related to government debt. What's your view on Brazilian government debt for the medium term? Maybe João can help in the answer. And then Brazil has very little foreign currency index debt. However, the debt duration is quite short. The gross debt might approach 100% of GDP. More than 70% of the government debt is indexed to fluctuation, either short-term rate or inflation. It's a little longer question, but I think that's what we have so far.
Great. On the 2 questions quickly, the underreporting, there certainly is a lot of underreporting. Deaths probably less underreported than the infections, but it's hard to explain away the differences through underreporting. I mean, just as an example, India's deaths per million is 15. The United States is 405. And Belgium is, I think, in the 800s or the 900s. So any industrial country is in the multiple hundreds at this point. And India is not the only EM. Many countries in Africa have fairly low death rates. Now, obviously, this may change, but I think it is a fact. And this is a study from the World Bank by its former chief economist, and my sense is they don't believe that underreporting could narrow the magnitude that much. On the issue of how much debt is too much, I mean, clearly our old projections are being thrown out of the window, right? It used to be that Reinhard Rogoff would say 90% of GDP is the limit for industrial countries. Almost every country we know will cross that over this crisis. India used to be 70% of GDP before the crisis. It's probably going to go up to 85 this year, and maybe higher if growth doesn't pick up over the next few years. So the industrial countries have the benefit of low interest rates. Emerging markets don't have that benefit. They have somewhat higher interest rates, though interest rates have come down, as you have said, and will probably, if growth doesn't pick up, stay at relatively low levels if growth and inflation doesn't pick up. So there may be more room. I don't want to opine specifically on Brazil because I don't know the specific circumstances. Let me turn it over to João to opine on that. But basically, across the board, debt levels are going up. We will have a new normal going forward. What that will be is harder to guess. And the notion that there is no limit, I think, of course, we can dismiss. There is a limit. That limit is higher the more fiscal institutions you have in place, which guarantee that you will come back to the appropriate fiscal path over time. And so if you want to expand limits now, you have to try and maybe also gain credibility, not just on the monetary institutions. And I should note that countries with inflation targeting models seem to have a little more room to undertake some of the support to the government than other countries. But also if you have fiscal institutions, that could be very helpful. Let me stop.
João, do you want to add anything about the situation with Brazilian debt? Or
yeah, sure, pleasure. I think it's pretty easy to say anything about Rajan. After Rajan, he's just I think he's just given us the clue. It's a matter of credibility of fiscal and monetary policy, and focusing on fiscal policy is a matter of having sound fiscal institutions. We firmly believe that the fiscal response to the crisis confirms the solidity of our fiscal institutions. Congress was able to circumscribe the fiscal response to 2020 and maintain the long-term fiscal pillars, which is basically one pillar, the spending cap. As long as the spending cap is in place, and there's nothing to believe that it won't be, it has survived this tremendous shock that we faced this year. You don't need a heck of a lot of growth to stabilize the debt to GDP ratio. Again, obviously, as Rajan has said, we can dismiss the notion that there is no limit. And Brazil, leading to this crisis, came into the crisis with a little higher debt to GDP ratio than India, gross to gross debt. And it will come up a little higher than the numbers that Raghu has mentioned, but having the spending cap in place pretty much is our fiscal anchor here.
I think we have time for some extra questions. We have something very interesting from the audience. Is for you, João. Is there any attempt to schedule for withdraw the measures that soften the provision for bond of loans? Do we risk create zombie loans in the medium and long run in Brazil?
I think we have to be very, it's a great question, thanks. I think we have to be very, very attentive to this, and we are going to monitor. The Brazilian Central Bank has a tremendous ability to monitor both credit and the fund markets. Obviously, the relief in provisions and regulatory relief that we put in place at the very onset of the crisis has a sunset, and that's why we are putting together new measures to reoptimize banks' capital, reoptimize their tax credit basically, so that we can reoptimize their capital base and use reserve requirements and directed lending from the real estate sector to SMEs, because the real estate sector is doing well, and SMEs have suffered a stronger shock, and we will monitor whether this regulatory relief could have detrimental impact on, let's say, creating zombie firms, with obviously detrimental effect for bank capital. We'll be very attentive to that.
Very, very nice. Thank you, João. Heitor, I will pass the word again for you.
Okay, so well, I just want to end by thanking everybody for the participation. We don't have any more time, right? I guess all the time. So time is the biggest constraint, right? So you know, I wish we had time to talk afterwards. You know, I also had some several questions here, but you know, we can do what we can do. So anyway, thanks a lot. Thank you for all the participants. I think we had at some point almost 200 participants, so it's great,
yes.
right? And you know, I want to end by thanking Sascha, Raghu, and João for, you know, excellent presentations. I learned a lot myself, and I think you know, everybody who attended learned as well. You know, I hope we can meet in person soon, all of us, right? Either in Brazil or in any other location.
Certainly in Brazil. Certainly in Brazil.
Yes, certainly in Brazil. Yeah, I miss Brazil, you know, but what can I do? Okay, thank you very much. Have a good day or evening, everybody. Thank you.
Thank you very much. We'll
Thank
keep
you.
you all here.
Thank you very much. It was a pleasure to have all you here with us. Thank you.
Thanks, Sascha. Thank you.
Bye-bye.